Having an accountant is not the same as having a tax plan. Those are two completely different things, and confusing them is one of the most expensive mistakes high earners make year after year. I want to ask everyone something. When was the last time someone proactively reached out to you? Not in March, not in April, not when deadlines were already breathing down your neck, but in the middle of the year to talk about reducing your tax bill before it was too late to actually do anything about it. For most people, the honest answer is never, and that silence is costing them every single year. Today, I want to introduce you to a concept that most high earners have never had explained to them clearly. That's the difference between tax preparation and tax planning, what each one actually means, and why the distinction matters far more than most people realize. This is the first in a series of videos on tax strategy. We will go deeper on specific moves in future episodes, but today is about building the foundation and simply understanding the landscape so you know what you are looking at and what questions to start asking. I'm Ken Erdman, financial planner and founder of Erdman Financial Group here in Lancaster County, Pennsylvania. Let's get into it. Let me define both terms clearly because they sound similar, but they are fundamentally different activities. Tax preparation is what most people do. You gather your documents such as W-2s, 1099s, any receipts from throughout the year, hand them to your accountant, and they file your return accurately based on what has already happened. It is a historical exercise. The decisions have already been made. The accountant is simply recording them correctly. Tax planning, on the other hand, is a completely different activity. It is forward-looking, it is proactive, it involves looking at your income, your accounts, your investments, and your financial picture throughout the year and making deliberate decisions that legally reduce what you owe before the year closes. Here is an analogy that I like to use. Tax preparation is like reviewing the game film after you have already lost. Tax planning, on the other hand, is the strategy session you have before the game starts. By the time you are sitting across from your accountant in April, the year is over. The income has been earned, the contributions have been made or not made, the decisions are locked in. There is very little left to do except report what has already happened accurately. Tax planning, on the other hand, happens in June, in September, in November, when there is still time to make moves that change the outcome. Most high earners have excellent tax preparation. Very few have implemented meaningful tax planning, and that gap is where significant money quietly disappears year after year. Here is the frustrating reality for high earners. The more you make, the more you pay in taxes, not just in dollars, but in a sheer percentage. Higher income pushes you into higher federal tax brackets. It can phase you out of deductions that you would have otherwise qualified for. It can trigger things like net investment income tax on investment returns. It can affect how much of your Social Security is taxable in retirement. And yet the complexity that comes with higher income also creates more opportunities for planning. More levers to pull, more strategies that are available, more ways to shift income, defer taxes, and create tax-free growth. The problem is that most high earners are too busy being excellent at their careers to spend time learning a tax code that changes constantly and requires proactive attention throughout the year. So they outsource it to an accountant, which is exactly the right move, but they stop there. An accountant prepares your taxes accurately. A financial planner who incorporates tax strategies helps you make decisions throughout the year that change what your accountant has to work with in April. Both matter. Most people, however, only have one of those things. I want to give you a simple framework for thinking about tax strategy. There are four broad categories of moves that make up most of what proactive tax planning actually looks like. Category 1 is tax reduction. These are moves that directly reduce your taxable income right now, such as maximizing pre-tax retirement contributions within your 401k, your SEP IRA, or your HSA, or capturing deductions you are entitled to but may not be taking. For business owners, that could also mean structuring expenses correctly. The goal is to lower the income the IRS gets to tax in the current year. We have touched on some of these already in earlier episodes with the HSA's triple tax advantage, the 401k match, and we will go deeper on specific strategies in future videos. Category 2 is tax deferral. These are moves that do not eliminate taxes but push them into the future, ideally to a time when your tax rate may be lower. Traditional 401k and IRA contributions are the most common examples. You pay taxes later rather than now, and in the meantime, that money compounds without being taxed annually. Deferral is not always the right move. It depends heavily on where you expect your tax rate to be in retirement. That is exactly the conversation we had in episode 8 on Roth versus traditional IRA accounts. The two strategies work together as part of a broader tax picture. Category 3 is tax-free growth. These are accounts and strategies where money grows without ever being taxed. The Roth IRA and Roth 401k are great examples. The HSA for qualified medical expenses, or certain life insurance when structured correctly. The goal is to create pools of money that compound over decades and come out on the other side without a tax bill attached. The earlier in your career you start building tax-free accounts, the more powerful this category becomes. Time is the ingredient that makes tax-free compounding extraordinary. Category 4 is tax timing. This is the most nuanced category and the one most people never really think about. It involves strategically choosing when to recognize income and when to realize gains or losses to manage your tax bracket from year to year. Things like tax loss harvesting and Roth conversions come to mind. Tax loss harvesting is selling investments at a loss to offset gains elsewhere in your portfolio. Roth conversions are deliberately moving pre-tax money into a Roth in a year when your income is lower than usual. Another example is timing the sale of assets to land in a lower bracket year. These are all tax timing strategies. Each of these deserves its own dedicated video, and each of them represents an opportunity most high earners are not capturing simply because nobody ever put it on their radar. This video is the foundation. Think of it more like a map of a territory. In the videos ahead, I'm going to go deeper on each of these categories with specific strategies, real examples, and clear frameworks for deciding which moves make sense for your situation. Roth conversions and when they make sense. Tax loss harvesting and how to do it without triggering wash sale rules. Asset location, which investments belong in which accounts for maximum tax efficiency. Business owner specific strategies and how it all fits together into a year-round tax plan rather than an April scramble. Subscribe so you do not miss any of these future videos. Each one builds on the last. Understanding the landscape is the first step. The second step is looking at your specific situation, your income, your accounts, your timeline, and identifying which moves actually apply to you and in what order. That is where working with someone comes in. Not just to prepare your taxes accurately, but to build a proactive strategy around them throughout the year. The difference between those two things is not small. For a high earner over a 20 or 30-year career, it can be significant. You do not need to have it all figured out before we talk. In fact, most people do not. You just need to be serious about getting there. All right, let me wrap this up. Having an accountant is not the same as having a tax plan. Tax preparation is a historical exercise. Tax planning is a proactive year-round activity that changes what your accountant has to work with in April. The 4 categories I mentioned above, tax reduction, tax deferral, tax-free growth, and tax timing, those are all the building blocks of a meaningful tax strategy. Understanding where each one applies to your situation is where real money gets saved. Most high earners are leaving money on the table every single year. Not because they are doing anything wrong, but because nobody ever showed them the moves that were available to them. That changes starting now. If any of this resonated, if you are doing tax preparation every April and wondering if there is more you should be doing, feel free to reach out. I work with people at every stage of the financial journey, and I'm always happy to have that conversation. Link to schedule a call is in the description. If this was helpful, subscribe. More tax strategy videos are coming, and each one builds on the last. I put out new videos every week with no fluff, just real planning conversation for people who are serious about building something. I'll see you in the next one.